Have you ever wondered, who owns a business? Is it just one person, a group, or maybe the government? Welcome to a world where ownership decides everything, from decision-making, profits, risks, to even the future of an enterprise. This is called industrial ownership. And in this video, we'll break down its types, features, merits, demerits, and even real-world examples. Let's get started. First up, sole proprietorship. It's the simplest and oldest form of industrial ownership, where one person owns, controls, and manages the entire business. So the features of a sole proprietorship are, well, pretty straightforward. It's owned and operated by a single individual. Decision-making is quick and centralized, which is honestly a big plus. The owner bears all risks and enjoys all the profits. And yeah, it's easy to form and dissolve. Now, let's talk about the merits. First, you get full control over the business. There are simple legal requirements, which makes things less complicated. Plus, there's direct motivation for the owner, since, it's all on you. But of course, there are some demerits too. There's unlimited liability, which can be risky. Also, limited capital and managerial skills can hold you back. And honestly, the business continuity depends completely on the owner's health or life. So, you might be wondering, what's an example of a sole proprietorship? Well, think about your local kirana shop, a freelance designer, or even a home bakery. Alright, moving on to the next one, partnership firm. When two or more people come together to start a business and share profits, that's what we call a partnership. Now, let's quickly look at the features. A partnership is formed by mutual agreement. There must be at least 2 and at most 20 partners. Profit and loss? Well, those are shared as per the agreement. And it's all governed by the Indian Partnership Act of 1932. So, let's talk about the merits of a partnership firm. First, it usually has more capital and skills compared to a sole proprietorship. Plus, the risk is shared among the partners, which makes things a bit more comfortable. And honestly, it's easier to manage than those really large corporations. Now, moving on to the demerits. There can be disputes between partners, which, well, can get tricky. Also, a partnership firm has a limited life. It might dissolve if a partner exits. And don't forget, there's unlimited liability, which is definitely something to keep in mind. You might be wondering, what are some examples? Well, law firms, medical clinics, or CA partnerships are all common types of partnership firms. Alright, so now let's move to the corporate world. The joint stock company. It's actually a business owned by shareholders and managed by a board of directors. There are basically two types, private limited and public limited. A private limited company is a business entity with limited members and restricted share transfer. Alright, let's dive into the features of a private limited company. First up, it requires a minimum of 2 and a maximum of 200 members. Now, here's an interesting point. It can't invite the public to buy shares. And oh, don't forget, the name of the company ends with PVT Limited. Moving on to the merits, a private limited company offers limited liability, which is quite a relief, isn't it? Plus, it brings better credibility and professionalism to the table. And here's the kicker. It has perpetual existence, meaning it continues regardless of changes in ownership. Now, let's talk about the demerits. A private limited company cannot raise funds from the public, which might be a bit restrictive. Also, the legal formalities can be, well, a bit complex. It's important to keep these in mind when considering this type of company. So, you're wondering what an example of a private limited company might be? Well, think about early-stage startups like Ola or Zomato before they went public. Alright, let's dive into the basics of a public limited company. This type of company is open to public investment through stock markets. Alright, let's dive into the features of a public limited company. First off, it requires a minimum of 7 members, and there's no upper limit to how many members you can have. Pretty interesting, huh? The shares of these companies are traded publicly, which means they're accessible to everyone. And of course, they're strictly regulated by the Securities and Exchange Board of India, or SEBI for short. Now, onto the merits of a public limited company. One major advantage is the access to large capital, which can really help in scaling the business. Then, there's perpetual succession, meaning the company continues to exist even if the ownership changes. And let's not forget, shareholders enjoy limited liability, so their personal assets are protected. But, like anything, there are some downsides too. Forming a public limited company can be quite expensive and complex. Plus, there's a need for greater public disclosure and adherence to strict regulations, which can be a bit of a hassle. Wondering about some real-world examples? Well, companies like Tata Consultancy Services, Reliance, and Infosys are all public limited companies. They're quite well known, right?
Cooperative organizations. These are built by people for the people. The primary goal? Serving mutual interests, not chasing profits. Membership's voluntary and everyone gets an equal say, one member, one vote. When there's a surplus, members share it. What's great? Cooperatives promote social welfare, give everyone equal rights and limit personal risk. But they often struggle with limited capital, sometimes lack professional management and can face political interference. Think Amul, Sahakari banks and sugar cooperatives. Next, public sector units or PSUs. These are government-owned industries, often in critical sectors like defense, energy or transport. The focus is on public welfare, not just making money. PSUs are massive job creators, help develop less advanced regions and provide reliable public services. On the downside, they can be bogged down by bureaucracy, face efficiency issues, and are sometimes influenced by politics. Examples: Indian Railways, ONGC, BSNL. Finally, private sector units. Here, individuals or corporations run the show purely for profit in a fast-paced, competitive environment. They're efficient, flexible, and quick to adapt, but sometimes ignore wider social responsibilities and can worsen income inequality if left unchecked. Big names: Tata Group, Adani, Infosys. Quick recap. You've got a range of organizations to choose from, each with its own perks and pitfalls. So if you're dreaming of launching a business, remember, the right structure shapes your success. Like what you learned. Hit like, share, and subscribe for more.